Hey, what is good everyone? It's Cam from Carg here, and today we're going to be talking about the best Australian stocks to buy during a time of inflation. So in this video, we're going to split it up into talking about what makes a good stock to buy during inflation, and then we're going to talk about the stocks that I'm buying during inflation, and then we're going to talk about some other alternatives that you can also go for, why they're great, and how they've kind of performed previously. And as you can see, there's little chapters in the video on the bar below, so you can skip to the section that you want to watch right now. I'll start the video by giving you a definition of inflation, and that is an increase in the level of price of goods and services that households buy, which pretty much means that everything will cost slightly more than it did before. So I think the example that most people use is milk. So like, let's say milk cost $1 one year and then it's $1.20 next year, and it's not because the supply of milk or cows have become more rare or anything. It's just simply because everything now costs more. So obviously inflation is a big thing right now with the RBA hiking interest rates and just everything that's happening in the world and everything that has happened and the knock-on effects of the things that have happened. And that can heavily affect some companies. More importantly, it will heavily affect the way that investors put money into things. They're less likely to take a risk, especially when wages aren't increasing to match inflation. Therefore, they have less discretionary income to spend on things like tech stocks and cryptocurrencies. So you kind of have to pick the companies that are just generally better companies that are going to make more revenue and perform better. Now, Warren Buffett has two principles that he says you should look to when you're buying stocks in a time of inflation. And that is, number one, an ability to increase prices rather easily without fear of significant loss of either market share or unit volume. Which in plain terms pretty much just means, can they increase the price and consumers have no choice but to buy anyway. The second principle is an ability to accommodate large dollar volume increases in business with only minor additional investment of capital. Which in simple terms means, can they make a lot more money without spending a lot more money? So now let's talk about the stocks that I'm investing in. This is not financial advice. I have no affiliation with these companies. Don't do what I say, okay? Everything is up to you. I'm not liable for any losses or profits you might make. Do your own research, etc. Now first we have my favorite company, and as of the recording of this video, it's taking a huge dip, so I reckon it's a good time to buy in. I'm buying a lot right now, and that is Mineral Resources, ASX code MIN. They're a Perth-based mining company founded in 2006 with a market cap of $8.21 billion, with their main products being iron ore, and they're really getting heavily involved in lithium. Source of income right now is selling iron ore, which is obviously a mineral that countries need. It's not something that they can just be like, oh yeah, we don't need any more iron ore anymore. No, most countries are investing in construction and stuff just to help stimulate their economy and keep their economy running, especially China. Obviously, they've decreased their iron ore, but it's something that people need, which means they're easily able to increase their price. And obviously, if iron ore and lithium prices increase, then they'll make a lot more money without having to invest in more infrastructure. So they're a great company, and talking about how great they are, obviously they're involved in lithium, so they're going to be a long-term player. You know, if their lithium mines take off, when lithium skyrockets even more in price, as we build more electric vehicles, we get more into green energy sources, and people need to be storing electricity somehow. Mineral Resources will definitely be a very profitable company in the future. But the next stock I'm investing in is Wesfarmers. Obviously, they're a huge company, ASX code WES. The thing about Wesfarmers is they kind of own just so many. They are like the blue chip company for Australia. They own Bunnings, Kmart, Target, Officeworks, a bunch of pharmacy, catch.com.au, CSBP, Clean Heat, some lithium company that I don't even know about, Flybuys, and most importantly, Coles. Now, pretty much all these companies that I listed, with the exception of like CSBP and Clean Heat and those kinds of companies, their main companies, Catch.com, Priceline, Bunnings, especially Coles, they're selling essentials. The demand for these products are pretty much inelastic, okay? They're not really changing too much. When people need tools, they're gonna go buy tools. It's not like, oh, I have more money now, I'm gonna buy these tools. It's like, no, I need a tool, I'm gonna buy these tools. I need eggs, I need food, I'm gonna go buy these food. Oh, I got a headache, I need Panadol, I'm gonna buy this Panadol. And even to an extent, CSBP, if a farmer needs fertilizer, he's gonna go get mass fertilizer. He can't just stop producing food. And obviously the diversity that they have in all their companies is gonna help you a lot. It's kind of like buying an ETF. You know, they have so many large companies inside of this one large company that it's not really gonna fail. I mean, they have a $52 billion market cap. They're still giving out 3.7% dividend. You know, they're a little low right now from when they peaked back in August of 2021. So it's probably a pretty decent time to buy in. So as you can see, they're a pretty solid company. But moving on, we're going to talk about some things that I've just seen recommended in certain articles I've been reading that I definitely thought is interesting. If you watch some of my other videos that I recommend you check out, I'll chuck them up on the screen here. And they'll be linked in the description. There's some pretty interesting ETFs in markets that are supposed to do well during inflation. There's an ASX code IXI. It's an ETF provided by BlackRock's iShares, containing some of the biggest supermarkets and consumer staples from across the globe, not just in Australia, but it's an Australian ETF, so you can buy it on the ASX. It gives you just like a good overview of kind of supermarkets in general. So last year, it's up 2.85%. The last 5 years, it's up 30%, because at the end of the day, everyone needs groceries. The last 12 months is giving out a 2% dividend yield, meaning the last year, the actual return is 5.28%, including management fee. Last 3 years, on average, 5.95% per year. Last 5 years, on average, 7.02% per year. And in the last 10 years, 11.83% per year. So if you are looking to get into supermarkets, it's really good. Some other stocks you can look into is just Coles by itself, COL, Woolworths by itself, WOW. But moving on, if you're still into the energy stocks and commodities, another good ETF is ASX code FUEL, FUEL, provided by BetaShares, consisting of some of the largest global energy stocks, which is obviously a good thing during inflation because everyone still needs energy. Even like coal is making a return as everyone tries to like scramble for greener energy sources, and it's like it's not able to supply enough energy to keep up with the demand. So all these kind of fossil fuel companies are still doing really good. Obviously, you know how the fuel price has been going, so ASX code FUEL will give you like a broad range of those type of companies. In the last year, it's up 27.25%, and it's currently giving out an annual dividend yield of 4.43%, which is pretty high. But that's all I really got to say. Before you buy any of these stocks, I'd recommend you do your own research, obviously, but that's just like a good brief overview of a few stocks that you can kind of get ideas of what to buy during inflation and what I'm buying. I do like ETFs, but I'm trying to kind of get away from them and try to do my own research a little more and like try buy individual companies a little bit more so I don't have to pay for management fees. But obviously just buying an ETF like FUEL is a lot easier than trying to go and buy individual companies and stock picking. So I hope you guys enjoyed the video. If you did, please leave a like, subscribe. I really do appreciate it, and I'm out. See ya.